From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the 5th of July. Well, the Brewers are in L.A. for the long July 4th weekend and then fly cross country to Pittsburgh. Summerfest wraps up this weekend, and you'll have to go to the county parks for the fireworks, unless you're the daring kind who doesn't mind losing a finger. Let's start with a crocodile. A croc was terrorizing a small Australian town by chasing children and eating their pets, so the residents killed him, cooked him, and ate him. He was 12 feet long and fed nearly everyone in the village. The lead singer of the legendary Four Tops is suing a Michigan hospital. The staff thought he was delusional because he told them he was the lead singer of the Four Tops. They didn't believe him, so they put him in a straitjacket when he was clearly having cardiac distress. I'm surprised they didn't ask for autographs. And finally, an American Airlines passenger is being sued by the FAA after being duct taped to her seat. Heather Wills is her name, and reportedly she bit, kicked, and spat on the staff and attempted to open the front cabin door. Duct tape. Don't leave home without it. On the podcast today, we have Dave Sandstrom, Adam Baley, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. No closing numbers this week on a trade-shortened week with the 4th of July on Thursday. We're going to record a little bit ahead of time here, and so numbers will be available, but not recording them on the podcast today. Instead, I want to spend just a little bit of time with the idea of what it means to be an investor here in America and all the great opportunities we have, all the reasons why it makes sense often to focus on investing in U.S. businesses. You know, we are such a global economy now that it is so easy to say, well, what's the right amount to have in foreign stocks? What's the right exposure I should have as an investor? And plenty of reasons why you want some. But I think it's also critical to understand that what happens here in the U.S. is a great reason to be a U.S. investor. And that isn't necessarily unique to us. Home country bias is a topic that's been written about. We've talked about it on our own YouTube channel in the past. But when you look globally, it is a concept that is quite common. Investors in Australia and the UK and Canada have proportionally more of their portfolio invested in their own countries than they do in what they otherwise would have as their country's proportion of gross domestic product or as investable market. And so when we kind of jump off from the idea, Adam, it's, I think, fair to understand that this isn't unique to just country or even just us here in America.
No, it's not. And I think it just hits home with invest with what you know. I mean, in essence, it's kind of a theme, and that's true here in the United States. It's true in Europe. It's true in Australia, where Australian investors would probably have a lot of their own personal assets in Australian companies, or a German in Germany, or a United States citizen here in the United States. And it does make a fair amount of sense. And that's essentially what we mean by home country bias, is having the dominant share, the lion's share of your equity exposure or even bond exposure to your own country and your currency. And here in the United States, there's lots of reasons to have that, in part because we have, stable government, we have stable infrastructure, we have exposure to very profitable growing businesses and good accounting practices. So there's lots of reasons to have a dominant exposure of your portfolio here in U.S. businesses. But you got to have more than just U.S., because there's lots of opportunities overseas as well.
Yeah, and I love the invest in what you know. There was a great study going back to the 90s looking at the breakup of AT&T, and you had all of these baby bell companies coming from Ma Bell that were regional specific. And when you looked at who the majority of investors were in those businesses, they tended to be people from those regions. It wasn't even I want this American company. It was I want the baby bell that's specific to my corner of the U.S. because that's the one that I'm paying. That's the deal I'm getting. That's the sales that I'm helping stimulate when I make that long distance call. And so I think, we see it across the board. And then I think as we look at what it means more broadly to have that home country bias, I think it's fair, Dave, maybe to understand that the way we look at a portfolio strictly measures domicile, right? It strictly measures what's the headquarters of the company we're buying. Is that a U.S. company, an Irish company, a British company, whatever that looks like? But when you think about the nature of businesses here in the U.S., they're not strictly selling to U.S. consumers. And so I think there's a bigger story than just strictly where's the headquarters for this company.
And I think, Kyle, it has a big role in why we've seen over the years some of that benefit of the diversification by company based on where they are located because of the multinational and just basically the globalization of the world economy. So, companies here in the United States, big ones that they're selling in every market across the planet. And so you are getting that international exposure through those revenue streams that, quite honestly, 50 years ago or 60 years ago, you probably had to buy the company that was in that particular market to take advantage of those consumers. So, and it's played out in the correlation of those two asset classes, U.S. Versus international stocks. There used to be a much lower correlation between the two prior to that globalization, prior to maybe the late 80s. Correlation between those stocks was around only about 40%. So you had a pretty good diversifier there. Now that's probably about 80% correlation between the two, and it's probably because of that. The globalization and the multinationals taking, basically spreading out the risk.
To put some more meat on the bone from this, if you were to just own one share of the S&P 500, all of those are companies domiciled here in the United States. But when you look at revenue, even though they're all here in the United States, 40% of their revenue comes from overseas. So even owning just U.S. businesses, you still have access, to your point, to consumers across the globe in different countries and different currencies. You're doing business around the planet.
How hard would it be to try to get a portfolio that was 100% U.S. companies doing business only in the U.S.?
Nearly impossible unless you want to buy just utility stocks or something that is a very niche product. It's really hard to bottle up electricity, transport it over to France. They're going to make their own electricity and transmit it over their own lines to their customers. And so there are some businesses certainly that are 100% or nearly 100% central to their country, their region. But the vast majority of businesses, even very small businesses now, are doing trade globally, even if not intentionally. They have buyers that are all over the world. And I think it does speak to the global nature of these businesses. I was having a conversation with one of our colleagues that came from an auto parts supplier earlier this week, talking about how their business essentially is with headquarters in 25 different companies. They're an Ireland domiciled company, but when you look at where the business is actually conducted, every business unit has a different country that they would call home. And so her paychecks would sometimes come from Italy or from Ireland or from a Caribbean island, just depending on what project she was working on, because that's the business unit that was ultimately paying the salary. And so when you think of it that way, right, okay, Wisconsin Electric, probably mostly going to be revenue from Wisconsin consumers. But if you really are a company that sells anything that even remotely can be transmitted across a wide range of the world, you're probably dealing with a business that's got some revenue outside the U.S. I think as we look maybe a little bit more broadly at just how meaningful some of the opportunity here is in the U.S., I think there's lots of reasons why the things we do here look a little different than the rest of the world. Dave, we spend a lot of time on the podcast talking about the opportunities in technology. Well, you look at all of the technology businesses in the world, some of the biggest, most profitable are right here in the U.S.
And I think that also leads to, at least in the United States, this home country bias, right? And the size of our stake here in this market is, if you want to own tech stocks, you're going to basically be buying U.S. companies. And so that's going to that's going to overweight your position as it is. Now, one of the things that does raise that attraction for some of the overseas markets is valuations. If you look at right now, in part because of the tech exposure here in the United States, you look at PEs overseas, very close to their long-term average right now, as opposed to here in the United States. You could argue that PEs are elevated to some pretty steep, price points. So I think there's some opportunities overseas with the attractiveness of those PEs. But yeah, the tech companies have certainly been the dominant place to be recently.
And it also plays into just market concentration as well, in part because here in the United States, we have a lot of the biggest tech businesses. And it has just led to a lot of market concentration, a lot of market dominance, if you will, by U.S. companies. And, the dominance isn't an issue. It's not unprecedented. It's something, if you remember back to the 70s or 80s, the Nifty 50 from the S&P 500 back then, or the Magnificent Seven as we call them today. Market dominance is not a problem for as long as it continues to be supported by the fundamentals. And for now, at least, interest rates still historically low, earnings still on the rise, the fundamentals still can support for the moment.
Yeah, we've talked a lot about the stock side of the portfolio, and certainly I think a lot of reasons why U.S. investors should focus a lot on U.S. businesses. There's another part of this conversation, though, and that is that what we choose to invest in isn't strictly stocks. And Adam, I know you spend a lot of time looking at opportunities in the bond market, talking about kind of what that means for investors. Historically, there were often better yield opportunities outside the U.S., and I'm not sure that's the case anymore.
Yeah, and when it relates to bonds, if Joel, you asked the question, can you build a portfolio of 100%, U.S. centric? Maybe not in stocks, but you can in bonds, specifically in municipals. And that's one of the areas where you probably want to be U.S. centric, especially if you're in a higher tax bracket. Municipals don't make sense for everybody, but if you're a U.S. investor and you're a higher taxpayer individual or family, you're going to want to have some municipal bonds. And more broadly on the bond market itself, I guess I don't have any problem at all being U.S.-centric in your bond portfolio allocation. Because once you start to introduce non-U.S. bonds into your otherwise safe money, you're now introducing currency risk or political risk. And for the vast majority of people, I'm not so sure that's a risk you might need to take. If you do have some non-U.S. bonds inside of your safe money, your bond money, yeah, keep it modest. I always like to carve out at most maybe 5% for bond money outside of the U.S.
We talk about levers of risk and what can you pull that might create opportunity or cause volatility within your portfolio. And generally for bonds, it's credit and interest rates. And if credit becomes a problem, if we see rising defaults, and you pulled the credit lever as something that you wanted exposure to, you're going to feel the pain of those rising defaults. And if interest rates are the lever you're pulling, if you want exposure to the potential for rising and falling rates, well, remember that inverse relationship. Rates go up, your bond prices are going to go down for a while. Rates go down, it's going to work the other way. To your point, Adam, you add in that foreign bond component, and now you've added a whole nother lever. Not just from now we also have the currency risk perspective, but also from what global central banks do isn't strictly tied to what our risks are. And so, Dave, we've got some very specific risks to investors here in the U.S. I think inflation being probably the bigger one speaks to maybe why the Fed might be doing things a little different at times than what other global central banks are doing. And maybe another reason why beyond stocks, beyond bonds, there's a range of investment opportunities that are specific to U.S. investors.
It's interesting that you bring up the point about the central banks globally, Kyle, because we came into this year and it was, as markets were looking, it was a no-brainer that our Federal Reserve was light years ahead of the rest of the central banks around the world, and here we are, and there's multiple foreign central banks that have already cut rates. In their attempts to, already start to spur some economic activity. So it does create a situation with the foreign fixed income market, certainly as volatile or even maybe at times more volatile than here in the United States. And I think to Adam's point too about some of the risks that's involved with investing in these other foreign countries and fixed income, it was a double whammy when you looked at the zero interest rate policies that actually occurred globally. That wasn't just here in the United States, that was everywhere. And so when you completely take all the yield out of the market and you still have that risk, it really made it unattractive. Maybe that works its way out now that rates are normalizing a little bit and maybe some opportunities come up in the future, but that was a pretty tough sell over the last 10 years.
Well, yeah, the Japanese bond is now a positive 0.9%. So is the German bond, which is 2.4. It wasn't too many years ago when we were talking about negative interest rates, and they're positive now, which is good and it's healthy to see.
I think it is such a critical reminder that U.S. investors and being an investor in the U.S. and investing in the U.S. encompasses a whole bunch of risks that are specific sometimes to our region, but also that when you view the world more globally as we've had to, again, Adam, your earlier point, 40% of revenue for the S&P coming from outside the U.S., and Dave, when you kind of view some of the risks of global central banks that you were talking about, I think there's so many reasons why we're going to continue to be focused, not exclusively, but certainly more than we might otherwise, on the opportunities that exist here in the U.S. That said, as opportunities emerge globally, as U.S. businesses kind of become more or less profitable and more or less of value, it's going to be necessary to reassess that. And so I think, there isn't a right number. Sometimes the question I get, what's the right number to have in non-U.S. stocks, or what's the right number? Yeah, we have guidelines, we have rules of thumb, but it very much is specific to the opportunity set that's out there. And so I think, our attempt to be patriotic this week with the 4th just behind us now, and certainly as we kind of think through, all right, how do we build a portfolio that best takes advantage of the opportunities that are out there? I think a lot of the U.S. stocks that we so much care about need to continue to be a big part of that. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.